Okay guys, there's a deal, okay? It seems that more and more financial YouTubers that are on the stock market are saying there's a crash coming and the valuations are too high and yada yada yada. But there's one most important factor to this that can either crash the market tomorrow or keep on going 5 more years. And this is what we are talking about. The Fed.
We wish you a Merry Christmas. We wish you a Merry Christmas.
Stock market crash. Something that is so dark and so bad, right? I mean, we had a couple of them over the last couple of decades, and it seems that it's a very nice keyword that you get a lot of views because it triggers emotion, and then emotion triggers people to click on something, and I want to just to demyth all of that, okay? In my personal opinion, if there's YouTubers or economists or anything out there that's not put the Fed into the equation of their theory of a stock market crash, are absolutely Wall Street clowns, all right? Because I will prove to you today that the Fed can be the only single reason that this whole thing goes further a couple of years or tank tomorrow. And I truly prove you that. Let's first talk about the stock market crash, which is by Wikipedia the following definition. The stock market crash is a sudden dramatic decline of stock prices across major cross-sections of the stock market and resulting in a significant loss of paper wealth. Crashes are driven by panic selling as much as by underlying economic factors. They often follow speculation and economic bubbles. And this is true, guys. So first of all, to have a crash, we need to have a lot of people selling at the same time, or maybe we have like an economic effect like we had with the health crisis, a black swan, so to say, that impact how economy will be, or we just have a bubble. All right, so we just had the second that I introduced, the black swan, my personal opinion. We had the crash of March. And now the question is, what happens next, right? Because the valuations went super high and, the people are scared that it's going to burst at some point. And I believe that can happen, right? Of course. I mean, this kind of mania that can be triggered by cheap money is so important to understand. But for that, I need to take you a little bit into the history of bubbles and the Federal Reserve in that perspective. And we actually start in the 90s. You remember Backstreet Boys and Co. was the top of the charts, and there happened something quite significantly in Japan. There was the Nikkei crash, okay? And the Nikkei crash, actually, because Japan is such an exporting nation, affected also other countries in the world, and also America, and therefore US brought down the interest rate. And guess what happened? The stock market developed and found a new darling, the tech stocks. I mean, pets.com, Amazon, anything with a .com name was absolutely a banger. And it continues until approximately June 2000, where the Federal Reserve decided to hike a little bit the interest rate. And guess what happened? The .com bubble bursted, okay? So it started in the summer of 2000, as you can see here, slowly in August. It went down and then got its downturn at about 2003, and we lost by then about 32%. There's no official percentage cap for the definition of a stock market crash, but usually you say 5 to 10% is like a correction. 10 to 20%, like 20% you say officially it's a recession, and then 30% I would personally say it's a crash. Okay, like 30%, something like we saw in March, is definitely a crash in my personal opinion. However, so what happens then? The Federal Reserve said, you know what, no, we have to bring the money down cheap, turn on the economy, and people, you know what, you should buy the American dream, buy American houses, and you get cheap money, cheap loans, and get flexible rates loans, because those are fantastic, because those are, you will be just amazing with that. And mainly Alan Greenspan, the equivalent of today's Jerome Powell, was one of the persons that let the people just take mortgages and mortgages in the second house and the third house. The housing market is so strong in the US. And guess what? The stock market got crazy. I mean, everybody and the investment banks, like, how we can profit from that? Let's create this crazy packaged loans, right? And put a AAA rating on them, because it's the American dream, right? The housing market will go just on and on and on. And yeah, at some point the Federal Reserve said, you know what, we need to hike a little bit our rates because the economy seems to heat up a little bit. And guess what? The bubble bursted, and once again in 2008 and 2007 we lost a lot of funds. Here, as you can see, just from the end of August until the end of February 2009, we lost about 40%, 37% of value in the S&P 500. This is huge, guys. It was one of the biggest global crises ever. But guess what? The Fed came in and said, we will penetrate the market with cheap money. Okay. And we will do this. And actually, there's one very specific date or date localization where the money really started to flow into the system, and it was March 2009. And let us see what actually happened in March 2009. Oh, let me guess, it was the bottom of the crisis. Oh, really? Oh, really? So as you can see here, guys, the Federal Reserve just gave so much cheap money into the market that we had the biggest bull run since then. And there was thousands of people that say, the crash will come, the crash will come. And actually you can see another proof of this concept is actually in September 2018. Okay, so let's zoom a little bit in. And here you can see in September 2018 something happened. Another rate spike, and the people said, wait a minute, I mean, the Fed increasing the rate, but the economy doesn't look like that well, so what happened was the market lost about 20 almost percent. I remember that as it was yesterday. The market just panicked, and within just a couple of months we lost almost 20% of the value in the S&P 500 until the Fed said, oh, you know what, maybe you are right, maybe the overall economy doesn't look so good, and we need to go down from our 2.25% rate basis to something lower. And then, it just came forward, and then came the black swan, the health crisis, and then, it all basically got a reset, and the rates went so much down as of almost negative. And therefore, the market, just was flooded with money. And what happened? And obviously, a huge recovery. I mean, since March, we recovered 44% in the S&P 500. And there is, for now at least, and I think you agree with me, there is no outlook that this will change. All right? It is not foreseeable for at least a year or two that the federal bank says, we will put up the rates up, right? This would be ridiculous. This would be suicide for the economy, because the economy now needs the money to build up again and again and again. Because in the end, the companies that getting this cheap money, using it to invest and to get new people, and the people working for their money. So in the end, it's for the people of the country. And with this hugely economical impact, This is absolutely ridiculous. Now, let's talk a little bit about the overall S&P 500 return. Because if you want to know the expected return on $100 invested, or 100,000 or 100 million in the S&P 500, you need to look into the earnings, the PE ratio, right? Because you're investing into the S&P and then you get something back as earnings of the company. So we are currently at the level of 31. If we are going into the PE ratios of the history of the S&P 500, as you can see here in the perspective of a 5-year chart, it's higher. But there's two things to remember. First, the earnings are a little bit pressured, obviously, because of the current crisis, and the valuations went high because the S&P 500 is valued by the biggest companies inside, and this is Amazon, Apple, and so on, Microsoft, right, which did great in the crisis, right? They actually increased their user base, their cloud business, and so on and so forth. So you cannot be that much triggered by that. And the second thing, if you translate this 31 into a percentage point, then this would be somewhere around 3.1% return. If you're going now into the 10 years treasury yield, which is an alternative, right, for hedge funds, for big ETFs, for pension funds, then you see that there is the return of 0.52, which is, 1/6 of what you can get with equities right now. So there's always Tina, there is no alternative. But, on the other side, I think that, my biggest red flag in an overheated equity market is the Fed, guys. The Fed is so powerful, guys, you cannot imagine. They can spike and create a bubble. They can end the bubble. They actually almost finished a recession by putting so much money into the market in March that this was never happened before, guys, okay? So don't be afraid of high valuations, because if the money is so cheap for so long, obviously you have so high prices. And there's stocks, guys, that are still not recovered, right? Airlines, travel industry, they are still 50% or less from their all-time high. So it's not like everything is expensive, just the things that, got very much pushed up over the last bull market, which was from 2009 till 2019, and got now an acceleration even in the last couple of months. So yeah, I think you shouldn't be too much scared. Enjoy the party until the Fed will say, you know what, we think the economy looks great and we will raise the rates. This would be a huge red flag, for my personal opinion, that could spark like the end of the dot-com bubble. All right, so therefore, I hope this is a very nice educational video for you. You shouldn't be scared. Subscribe, like the video, and I see you tomorrow, because I am vlogging every freaking day. Jingle bells.